What do you see in this industry that, other people maybe don't see?
Something I've learned is that the biggest amount of money is just hidden in the obscure corners of the economy. Restoration being one of them. We're looking at, hundreds of billions of dollars being transacted on, just fixing properties from damage. Home services in general have an incredible reputation of being recession resistant. The PE guys, they're nothing without the souls of the mom and pop shops. And mom and pop shops oftentimes, they need that sophistication to get 100%. To the next level.
What are the top 3 things that plummet a restoration company? Like if we were to go in and walk into a restoration company, what would plummet the value? Which, by the way, we love because we can fix those things.
When you go invest in these brick and mortar essential services, you see the cash flow come out. It's not some pipe dream.
Yeah.
Folks with a lot of potential, with incredible drive and entrepreneurial DNA. That just needs a Sherpa to help them get to the mountain.
Yeah.
You gotta engineer, you gotta have a map to get there. And it just sucks to see incredible entrepreneurs who just spin their wheels. Understandably so, most restorers are like, yo, I gotta fix the next job. I gotta go hire my next PM. I gotta do this estimate. Who has the time to think about 3 to 5 year plan? No one does.
The first thing that I would think about as a restoration business owner is like, what's my business worth? How do I know what my business is worth? And a lot of times I think what happens is there's not a lot of clarity around this. And a lot of times restoration business owners think of their business as their baby.
My goal at the end of this is to have, let's say, 10 owners who I've personally made multimillionaires that I enjoy working with like I do with you. And on the other side of the sale, we invest together, we talk about finance together, we talk about new ideas together and grow together.
Welcome to the Albi After Hours podcast, where we talk about propelling the restoration industry forward. I'm your host, Alex Sudan. Today, I'm super excited to have a very special guest that I've worked with for, 3 years now together?
Wow.
Something like that.
It's 3 years.
Yeah.
Okay, 3 years.
Yeah, my favorite part about our relationship is that, when you find somebody that you absolutely love working with, you find every excuse possible.
My girlfriend tells me, it's like, oh, it's Alex. Okay. She always, when you call me on your way home, it's like, oh, it's your other lover. So yeah, she knows we have a very good working relationship. I love talking with you, not only about restoration, but just about life. So pleasure to be here, dude.
Yeah, super pumped. And for those of you guys listening, stay till the end. We're going to unpack the top 3 things that plummet the value of your restoration business. But before that, I want to dive into your story. Today here with me is a partner, early believer, early investor, and personal friend of mine, Joey Kim.
Yes.
What's up, man? How are you doing?
Pretty good. Living the dream, as you say.
Yeah? Yes. Are you actually?
Yeah. Actually, the other day I was talking with my girlfriend and I told her, wow, I really love my job. I really can't be complaining about anything, even during the late nights. So, we're going to unpack awesome. Exactly what I work on. So,
yeah, man.
Yeah, I love it.
Well, let's dive into your story. Let's start. I think you and I kind of clicked over our immigrant stories. Let's start back in the day when little Joey came over from South Korea, not North, right. South. You always correct me. And let's start it. Where did it all start?
My journey started when my family immigrated from South Korea. We were dirt poor. My dad was doing his postdoc. He didn't have much money. We just came, my sister, myself, my parents, to West Lafayette, Indiana, of all places. And I still remember coming off the plane with 4 suitcases. Wow. Without speaking a word of English. And from there, my family, I owe a lot to them. They give me my work ethic. When you immigrate, you know this. Yeah. It's all in. Everyone has to do their jobs, and my job was to, be diligent about studying, be a good, Korean boy, practice my violin. But along the way, as got into Harvard, spent some time at Harvard, learned about entrepreneurship, ended up starting a startup, which frankly didn't go anywhere. And then I just happened to stumble into management consulting at McKinsey. After that, joined a couple guys out of Boston. It's a venture capital firm called Romulus Capital.
Interesting.
That was an interesting choice as well, because at that time I had an offer from a competing firm that was much bigger
Than McKinsey or than the venture firm?
Than Romulus Capital.
Oh, okay.
And those guys were offering me 80% more.
Wow.
In terms of my salary. But I joined Romulus because I knew I was going to be able to grow faster there. So I just bet on myself. My mom didn't talk to me for at least like a week. It's like, what are you doing? It's like 80% more. And frankly, it was looking back on it, was the best decision I probably made at the time, because I got to work with the general partners there. And from that, I got to meet the founders of Equipment Share. So Equipment Share is now the 4th biggest construction equipment rental platform. But when we first met them, they were I think they were doing less than $1 million
Of revenue.
Wow.
What are they doing today?
They're doing over $3 billion.
Wow.
At this point. Those guys. And the great thing is, the thing I love about them is these 2 brothers out of Missouri, from nowhere, Missouri. They don't have college degrees. They were just solving their own problem, because they were general contractors. And they realized, hey, we don't have cash to go buy all the equipment. Let's share, this equipment with a bunch of people. And they built this huge unicorn. I got to work with them. And I loved working with them so much that I actually started my own venture capital firm called Takeoff Capital, as you know, Alex.
Yep. Our listeners need to know the story. So
okay,
go on.
Great. Yeah.
This is where it gets awesome.
And so I got to start that firm with them, and came across this tiny startup called Albi out of Chicago, of all places, because this is my home city. And I still remember, I just happened to be dog sitting for my parents. So I was like, hey, it's really nice to meet you. I'm just like 40 minutes away from you guys. Let's go grab lunch.
Yep.
And even from the first meeting with you and Shamoil, I just knew, like, it's really instantaneous. You just know the entrepreneurs, when they share your value. Ended up investing a total of about $1.5 million into Albiware. It's kicking some serious ass now. I love it. Sitting on the board, and the best part of that is over the last 3 years, I've gained an incredible friend and now a fellow collaborator into the restoration world. So now I'm working on looking at acquiring restoration companies.
Nice.
And we can talk about that later, but there it is. My entire story.
Yeah, the one thing I think we glossed over is McKinsey. There's 2 interesting projects that you worked on.
Yeah.
And I want to emphasize these things, but you're typically modest and you gloss over, just like you glossed over the whole Harvard thing. Let's just like put it here. And I know you it's uncomfortable for you, but I think it's important to tell the story. So what'd you do over at McKinsey? What were like 2 notable projects that you worked on?
So it's been enough time passed, so I'm past the NDA, because we have to sign all our NDAs. I worked with Angie's at the time. Spent a lot of my time there in Indianapolis, helping them think about pricing strategy. And I got involved with so many other clients. Spent some time in New York doing due diligence for financial institution for an M&A. Worked for a hedge fund's talent strategy. If I named the hedge fund, you guys would know it, right?
Yeah.
So
won't name it.
Yeah.
Chicago Ballet Company.
Yeah. Oh yeah. And then
I lost their endowment.
We did some pro bono for the Chicago Ballet Company, Joffrey company. Nice. So that was incredible as well. So I got to learn a lot about boardroom dynamics. I got to learn a lot about problem solving, incredible place to learn how to solve business problems.
Mm-hmm.
Wouldn't trade it for the world. Many late nights.
Yeah. They still happen though, right?
Yeah. Not as many
Got
nights now, but yeah, man, just like coming back to your hotel room at 9 p.m. and having still like 3 hours of work left.
Wow.
But you make it through it, you know,
Yeah.
and you're,
It made you a seasoned investor.
yeah. I think more than anything, they give you an incredible framework to think about problems. So
Interesting. So obviously, you know, for the past, 12 months now since the idea of Longview came up, you've spent quite a bit of time in the restoration space. You visited some of my private coaching clients. You visited our restoration company. We've put down a couple of letters of intent to purchase some other restoration companies. I guess why the restoration industry would be my first thing. And what do you see in this industry that, you know, other people maybe don't see?
yeah. So coming from, you know, the sexy world of venture capital and tech, you have to, something I've learned is that the biggest amount of money is just hidden in the obscure corners of the economy. Restoration being one of them. You and I know we're looking at, you know, hundreds of billions of dollars being transacted on, you know, just fixing properties from damages.
Yep.
But the thing that really interested me and private equity world in general right now is home services in general have an incredible reputation of being recession resistant. Listen, if there's a leak, you gotta fix it.
Yep.
You know, if your air conditioning doesn't work in middle of June, you gotta fix it, right?
Yep.
So, yeah, home services in general there's been a ton of activity going in there, and frankly, a lot of the there's huge complementary skill sets when it comes to operators, mom and pop operators who care about their customers, who will be the knight that shows up and fix, you know, a home in the middle of the night, and the sophistication of, you know, private equity investors when it comes to marketing and, you know, making sure you control your costs. The PE guys, they're nothing without the souls of the mom and pop shops. And mom and pop shops, oftentimes, you know, they need that sophistication to get to the next
100%.
level.
Yep.
So, yeah, that's why. The other thing I'll say here is cash flow is king. Cash flow is king everywhere.
Yep.
And coming from venture capital, when you do these investments,
Oh, man, it's crazy.
man, you're there for 10 years locked up.
Yep.
If
They're
you're
burning
lucky,
cash.
Burning cash. You're not seeing a dime come
$500,000
back.
a month. Like, to put it in perspective, right? Like,
Yes,
half
that's
a million,
right.
$1 million a month.
Easily. And even if you do go public, some of them continue to lose money.
Yeah.
So when you go invest in these brick and mortar essential services, you see the cash flow come out. It's not some pipe dream.
Yeah. Very interesting. And the Longview model, because I mean, this is probably the first time we're publicly talking about it.
Yeah.
I like to refer to it as a wealth management product for restoration business owners. So, you know, you look at private equity, right? You look at the Alpines, Higher Grounds of the world. They're going out there purchasing restoration companies wholly, right? And they're the typical private equity play. They come in there, pay you transition out as the owner within a year to two. And then there's this segment of the market that maybe we could talk a little bit about that doesn't, the majority of restorers don't fit the Alpine or Higher Ground model.
Yeah.
And they need more than coaching, right? But they can't just be bought out like 100% and thrown off, you know, to the side, because it's not the best interest for the owners. Yeah. So walk me through, like, what's the unique insight of Longview?
The number one thing you need to know is that private equity world in general is not a monolithic. It's a collection of different people with different strategies. And we'll talk about, you know, the Alpines of the world. Those guys, their strategy is to go acquire something that's already been set up, where the owner doesn't need to be in the business. The company's probably doing at minimum $1 million in, let's say, profit, but likely more than that. And then once they really want I'm biased, but they want the table set up so that they can come in and eat, right? So most people, most restorers are not there. And frankly, they will never get there. That's the reality.
Why is that?
You need to almost engineer your business in order for you to get there. So let's take owner independence, for example. It's not natural for most small business owners to say, you know what, I'm done. Like the business doesn't need me. In fact, that like creates a psychological barrier oftentimes. They want to be needed, and oftentimes they are.
Yep.
They need to be at the center of it. They need to be the quarterback because it's their team that they've assembled. So it's very unnatural for folks to just back into and stumble into a setup that PE funds are looking for. So owner independence is one of them. There are a bunch of other things in terms of margins and other kind of value add and cost synergies that they're looking for. But there's another, as you and I have been talking, something that we saw a gap in the market was folks with a lot of potential, with incredible drive and entrepreneurial DNA.
Yep.
That just needs a Sherpa to help them get to the mountain.
Yeah.
Right. And you can't, you gotta engineer, you gotta have a map to get there. And it just sucks to see incredible entrepreneurs who just spin their wheels, and as they get older, as they get burnt out, suddenly that engine starts to slow down, and then the potential essentially kind of dies and withers away.
Yep. And they either close down or they, sell on an impulse because they passed away or whatnot, and they truly don't find that true value.
It's a tragedy because when you have a Sherpa, when you know the things that you need to do, it's not that many. All right. And it takes probably about 3 to 5 years for you to go through that journey to get it set up for a good sale. But most of the time, and understandably so, most restorers are like, yo, I gotta fix the next job. I gotta go hire my next PM. I gotta do this estimate.
Yeah, creating the financial forecast or the model or strategy planning and stuff like that.
Who has the time to think about 3 to 5 year plan? No one does. So that's where I think Longview, I just wanted to work with those incredible entrepreneurs and win together.
So let's partner together. We'll come in, buy a percentage of your business, but not the entire thing.
Correct.
We're actually looking for the businesses that are unattractive.
To the
because
big guys.
they have these 3 pitfalls that we're going to talk about at the end. We love those businesses, but we're not just going to go give that owner a bunch of cash and have them walk away from the business. We're going to partner with that owner. We're going to coach that owner up. We're going to financially engineer the outcome. And then at the end, they're going to win because they're going to, have that outcome happen. And then we're also going to win too because we helped them and we were the Sherpa, and it's a win-win-win-win.
That's right. And along the way, I mean, my to be very transparent, my goal at the end of this is to have, let's say, 10 owners who I've personally made multimillionaires that I enjoy working with, like I do with you. And on the other side of the sale, we invest together, we talk about finance together, we talk about new ideas together and grow together. Something that I've learned from working with the unicorn founders over at Equipment Share, working with you and investing in, at this point, dozens of other entrepreneurs. When you find that person, someone extraordinary, you hold on to them for dear life, because good things happen and you win, and you end up winning together. It's just it has to happen.
Yeah, you find every excuse possible to work with that person.
That's right.
So
that's right.
Interesting. So for those of people listening out there, like, the first thing that I would think about as a restoration business owner is like, what's my business worth? How do I know what my business is worth? And a lot of times I think what happens is there's not a lot of clarity around this. And a lot of times restoration business owners think of their business as their baby. And like, if I were to ask you tomorrow, hey, what's your daughter worth? Or what's your dog worth? Right.
You're like, you'll look at it.
You'd be like, there's no amount of money. Right. Yes. So how do we unpack this? And like, what are some of the psychological things? And like, well, is there a science to evaluating a business, or is it more like an art?
Yeah. I think the best analogy that I could think of is like, you bought a piece of land and you created a custom built home. Obviously you have attachment to it. Obviously it houses your family, it feeds your family, right? Your job feeds your family, right? But you have to understand, as everyone intuitively knows, that house has inherent value to it. It is, especially at all stages, the way I like to frame it is there are guardrails on the evaluation of your company, but within the guardrail, it is very much of an art. Very similar to, selling your home, right? You know kind of what your range should be in your neighborhood, but people will have to come look at your home to actually fall in love with it.
And then at the end of the day, if you have multiple people bidding on your home, it could sell for above the appraisal. And then if your home's in a floodplain and half flooded or just caught fire, it could sell for a fraction of what it's technically worth, right? So there's an art behind that.
And to at the risk of tiring out this analogy, like there are few things, renovations you can make to your home that will come back multiple folds in terms of, rehabbing the value of the home. Now, what cannot happen again is you cannot let the home just decay and just fall into disrepair. And you see these beautiful homes with incredible, structures, bare bones, but they just look like absolute ghost houses and no one wants to buy it.
No curb appeal. There's liens on the property, which we'll talk about what the equivalent of lien on a business is and such. It's in a floodplain, right? Nobody wants to buy it. You can't insure it. So
So let's if we get into the nitty gritty of the actual valuation of your business, it really comes down to profit, and more specifically in financial world, you're looking for EBITDA, which is a fancy acronym for saying essentially how much money is flowing through your company, accounting for taking out like things like interest payments and taxes and depreciation and amortization.
The way I like to tell people is it's your net income before your accountant touches the thing at the end of the year.
Perfect,
kind of
right? So and this is true for all businesses. Fundamentally, your business is worth the cash flow today and the present value of the discounted cash flow of all the future cash flows, right? So you can almost think about it this way. If someone comes in and says, hey, I'm going to, give you 3x EBITDA. What they're saying is, hey, I know you're doing $100 today in terms of profit. You know what? I know that next year you're going to get another $100 and the next year you're going to get another. I'll just front load it 3 times. I'll give it to you for 3 times today's cash flow. Why? Because I think I can go in there and make it even better. Instead of $100, I know I can make it $150. We'll find out exactly how, and there are different strategies that investors have to do that. But that's when people say multiple, EBITDA multiple, that's what people mean.
I'm giving you X amount of years of what you would make anyway if things go as planned, right? Upfront for X percentage of your business.
Right. And from the owner's perspective, the restoreur's perspective, the way you should really think about this is, oh, great. So without doing any work, I'm going to get that money up front, 3 years, and I get my time back. I can use that time to go start another business or just retire or take that and manage my money, right? That's what's really happening when people come in and make now there's going to be a bunch of caveats to that. When PE firms oftentimes come in, they'll have a bunch of it's strings attached.
We can stay on for a year, don't stay on for a year, right?
Yeah, you got to sign a non-compete. they will also do kind of not shady, but they'll kind of do a fast one, pull a fast one on you by, trying to do an earn out of some sort. So it's like, hey, I'll give you 5, or let's say like 8x, multiple, right?
Yeah.
8 years of future earnings today.
Yeah.
But by the way, like half of that is in earnouts. And earnout is basically a bonus that you can only get if you hit certain performance metrics.
Yeah. Yeah. So when I was writing the book, for example, I sat and I interviewed a couple of people and I got a range of these multiples and such. And, in the book, I believe I wrote, at the time I had heard between 6 and 8.
Yeah.
And when we started working together, I actually had a hardcore database of 100 and some transactions. And, there were like 2 to 4, I think, where it was the multiple range. And I was so interested, and I started diving in with some of these private equity companies. I'm not going to name them for the sake of this, but I was like, how are you, purchasing these companies at 8x multiple when, this is what they're selling for? And the individual was, well, we tell the owners that we buy them at 6 to 8x multiple, but we tell our investors that we buy them at, 4 to 5x multiple. I'm like, what do you mean? Well, we'll go in there and, the owner's all jazzed up. He thinks he's going to hit, the sun and the moon within the next 12 to 14 months because
classic
the business
entrepreneur,
is on that,
right?
Yeah, the business is on that trajectory. And you'll tell me, hey, Albi, do you have conviction that Albi's going to triple next year? Absolutely. Yeah, I'm all jazzed up. And then, what's the probability of that? I don't know, but I'm super jazzed up about it. Yeah. And then they'll put people under an earnout where it's like, yeah, you're going to get 8x if the sun and the moon happens.
Right.
And then the likelihood of the sun and the moon happening is rather slim, and it doesn't happen the majority of the time. Yeah. And when you flatline and average everything out, the reality is those people that are pitching 8x multiples are buying in at 4 to 5. So
now,
it's really interesting.
The 8x multiple, you start to hit 8x multiple once you start to hit multiple millions of dollars in EBITDA.
Yeah, and then the business is running by itself like a well-oiled machine, so they can come in there and feast.
Correct. So if the dinner table is perfectly set and all the conditions are met, the business is independent from the owner, right? It has a great track record of the management team. If everything is set up perfectly and you're growing, right? Great. 8x is perfect for you. But for the long tail, for most folks, it really, I think it's pretty disingenuous for folks to just and by the way, sometimes real estate might be included in that deal. But I think it's pretty disingenuous to set this expectation. When for majority, I'm talking everyone else, 90%, the table is not set yet. And in fact, I'm going to guess that you're not an M&A expert, and this is probably the first time you're going through this. And it's very, it's very often that because you're selling all of your business or majority of your business, it becomes a transactional relationship where if you're the seller and I'm the buyer, it's a one-time game. And I'm trying to take as much advantage of your naivete and your unsophisticated, right? And I'm trying to take advantage of that. And I don't know, man, I just find that to be a little bit icky. Right? So for me, I've always partnered up with entrepreneurs.
Where there's a win-win.
And I need it. I structure it in such a way that it's never a one-time game. I want it to be a lifelong relationship.
100%.
And that allows me to not screw you over. Because that's the last thing I need.
Those are the most beautiful relationships, I think. Even an employee-employer relationship where you could be tied at the hip, where you guys win. If you guys win together, you guys win together. If you guys lose together, you guys lose together, right? And interests align. Your interests should be aligned with my interests and vice versa. So your values should be aligned with my values, and that's where beautiful things happen. But let's get to the top 3 things that plummet the value. We talked about that beautiful house, back to the house analogy, but what's the floodplain equivalent? What's the tax lien equivalent? The ghost town equivalent of that house that nobody wants to buy it. it's just a deal breaker.
Yeah.
Maybe you walk into the house and you look at it on Zillow and, oh my God, the Zestimate says XYZ. And you see the curb appeal and you're like, man, I really want to buy it. You open it all up, but then you get to that deal.
Like, oh, yeah.
Yeah. I'm a real estate nerd by trade. But so what are the top 3 things that plummet a restoration company? Like if we were to go in and walk into a restoration company, what would plummet the value? Which, by the way, we love because we can fix those things. But if we were a big PE company.
The top one, I mean, I've mentioned multiple times, but the top one is owner independence or owner dependence. So if
what do you mean by that?
If the business cannot exist without you as the owner, coming in every day, making sure, holding everyone accountable, most PE firms will not touch you.
Why is that?
The reason why most PE firms won't touch you if you haven't separated yourself from the business is because they plan on replacing you. So if that's their game plan from the beginning. They will buy you and take you out. And it's going to be theirs. And if it turns out that the team members aren't working as hard, if the customers are not there, if all the processes in your business cannot run without that important cog, in there, and you will never find that replacement, the boxes it's not worth anything.
Really interesting. So things like what, like having technology, like job management systems and stuff like that would be a way that, you could prove owner independence. Things like having a strong leadership team, right? With different mid-level managers and a general manager running the show. That's a way that you can see owner independence. The owner being able to go on vacation for 3 months without, wanting to pull his hair out or her hair out, right?
I was about to say that. If you go on a vacation for 2 weeks and everything falls apart, that's or you feel so insecure about leaving it, that's a pretty good sign that it's too dependent on you.
Makes sense.
That is natural. Most small businesses work that way, where the owner is end all be all.
So we're saying that this one, I'm kind of thinking like a Barbie doll right now. In the sense of, you're telling me that what PE really wants is the Barbie doll equivalent of businesses, and it's unnatural and not really very easy to achieve that, maybe even impossible to achieve that.
I think especially if if you, in your book, there's the Jack and George. If you're the Jack, oftentimes I see this quite often, where you're the one making all the sales. You are the reason why all the referrals are coming in. That's a pretty good and everything depends on your personal relationship, and it's very counterintuitive because you think the more I work and hustle, the more valuable my company will be. It's like, no, your company, you are not your house. Your company is not you. If you really want to have the value of the company stand by itself,
you can't be in the house when they're touring, showing the cupboards.
You gotta take yourself out. And a lot of it's a very unnatural thing for entrepreneurs. It doesn't come to them naturally because oftentimes they got to where they are because they've hustled. But as you say, hustlers fail at scale. Right. And then PE firms are looking to scale.
So what's the second thing that just absolutely plummets the value?
The second thing I've seen is something I mentioned, which is the EBITDA, or let's say profit of your company. Too many folks place too much emphasis on the top line. Now, it's one thing if you are investing today and putting all the money back into the business so it can grow to a certain level. But when you get to that level,
you have to grow into the shirt.
Right. Yes. But once you grow into the shirt, your bottom line has to still be there.
Exactly.
So I get it. And the greater you scale, harder it will be for you to maintain that margin. So if you can hit 20% and you're doing $10 million,
it's awesome.
That's great. Now, if you're smaller than that, your margins should be higher because you probably won't have things like the middle managers and things like that. But PE firms, when they come in, when I look at businesses, the first thing I look at is the EBITDA. The first thing I look at is your profit.
And it's the EBITDA growth over
Correct.
time, which is
Yes.
important, because a lot of times we're like, yeah, I went from 1 million to 10 million. Yeah, but you went from 200,000 of EBITDA to 300,000 of EBITDA, right?
Right. It's like,
So it's like,
yes.
yeah, you 10x your top line, right?
Yeah,
But
yeah.
you didn't do much with your bottom line. And then the other thing that I find very common within restoration is we're stuck on this constant hamster wheel of lying to ourselves that we always have the bigger shirt and we're growing into the bigger shirt, right?
Right,
And it's like common thing. It's like, yeah, EBITDA's low, but that's just because we're growing. And I use this example all the time.
Sure.
I mean, I pitch it to the board sometimes, even at Albi, where
Yes,
it's like,
yes.
but at the end of the day, like the easiest excuse we can say is, yeah, you know, we just got a bigger shirt.
So, I mean, here's how I would look at it is, let's take 100%. Let's say 100% is the revenue. If you're hitting, 50% gross margin across, your service lines, water, rebuild, content, maybe you do exteriors or something like that. If you're hitting 50% gross margin, good. That's pretty good. Now, what that means is you need to do everything else with the 30%.
Yep.
So your expenses. I'm talking your office staff. I'm talking maybe obviously the rent.
Marketing.
Customer acquisition. Now, I understand that, most business owners will oftentimes use their business in order to write off expenses, and that's okay.
Yeah, those get added back in.
Yeah, when I come in and say, okay, hey, like I saw that you instead of, paying yourself and getting taxed, I saw that you just used that, expenses to the, great. We will figure that out.
Yep.
But don't lie to yourself when EBITDA is shrinking or not growing as fast as your company, top line.
Got it. Interesting. And what's the third thing that plummets the business value or breaks those deals?
Debt.
Ooh.
Debt.
Tell me more.
Debt.
What happened? So I'm going to sell my business, my restoration business for $3 million.
Yes.
And I have that one line of credit that there's $2 million eaten up on. What happens at that point?
It's like this. You're selling your house, your custom built house.
Yep.
When you sell that house, you got to pay the remaining mortgage on there.
Yeah.
Now, if you are taking HELOC out on that house all the time, that still belongs to you, right? So if you have like $500,000 on your balance sheet as debt, right? And I understand, like line of credit, when fairly used, makes sense.
Exactly.
But make no mistake, that $500,000, that's coming out of your pocket.
Yeah.
So when we're making a deal and you have taken $500,000 out of debt under your name, under your PG, your personal guarantee, like when I give you $10 million for your business, that's coming out of your pocket.
Yeah. I've seen that happen so many times. It's like, hey, your business is worth whatever, 2 to 3 million, and you have $1 million of debt.
Yes.
What do you mean you're taking it away from me? It's like, well, yeah, if you had a $2 million house and you had $1 million mortgage, it's like, we wouldn't give you $2 million cash to you and then be
pay your
stuck to
mortgage
pay your
on top,
mortgage, right? So I mean, that's a common misconception. And again, back to the baby thing. It's like, I went through this whole process, went through the private equity process. I got this valuation, which felt like, my child, which is my business, just got valued sub what I expected my child to be. And then on top of that, now you're saying, oh, I then got to pay all this debt off. So therefore I have nothing. And I'm not like you said, you have to use debt wisely. Like one of the biggest pieces of leverage you have, I talk about all the time. It's like the 4 C's of leverage. It's, capital, content, code, and collaboration. But like, the biggest leverage you can have in building a business is capital.
Yeah.
And that comes in forms of lines of credit, that comes in forms of credit card and such. But you have to wisely use it to where you're not carrying this tax lien or this big weight across. Right. You know what I mean?
And also, I mean, you get the money, you pay down your debt, and then you also got to pay taxes on your gains. So suddenly it's like, wow, my $3 million sales suddenly went down to nothing.
Exactly.
So this is why you have to engineer it. Grab a Sherpa with you when you go up Mount Everest. You will only do this once in your career as a business owner. Oftentimes, for most people, just don't do it, and don't do it too late.
Yeah, that's huge. And what you're speaking about tomorrow at Evolve is going to be awesome with like perfect exit builder. Like start with the end
I'm
in
really
mind.
excited about that.
Want to walk away with $10 million cash. Well, here's the deal. You have to have this much EBITDA by this point. It has to grow this way. You have to make sure you're clean of all of the debt. And then also, by the way, if you want to walk away with $10 million cash, you need to have an $11 million or $12 million sale because you got to pay Uncle Sam, right?
Yeah.
And really starting and being intentional about that from the very beginning versus, oh, yep, this one PE guy came knocking on my door, started talking with him, boom, done. It takes years to financially engineer that end product. So that was great, man. Anything else that you'd like to add?
Yes, one thing. The PE folks, the financial world, they all miss one thing, which is the soul, and this guy sounds so cheesy, the soul of the company, which really manifests itself in terms of really high Google reviews. When customers write sincere thank you notes. PE guys don't know any of that. They haven't gone in the middle of the night to fix and save somebody's home. They know nothing about that, right? So that is the starting place of the conversation that I have. For me, it's do they have entrepreneurial spirit, and do they care about their customers? And frankly, those actually can be applied to Albi when I met you as well, right? So for all businesses, that's one thing I wanted to make sure that you never discount.
1,000%.
Yeah, P guys, financial guys know nothing about that.
Yeah. Interesting. That's awesome. In the link below, we'll put your social information and the Longview information as well if you guys want to learn more about Joey and such, or learn more about what we're cooking over at Longview. But Joey, this was really fun.
Yeah.
I'm excited to see you speak tomorrow here at Evolve.
Excited as well.
And thanks for coming out to beautiful Chicagoland to do this podcast with us.
Thanks for having me.
Awesome, man. We do a little hug here.
Oh, yes.
Our final.
Amazing. Thank you guys.
This is great. Yeah.